Welcome, guys. A very warm good evening to all of you. So let's wait for a couple of more minutes. Let's wait so that others can join as well, and then we'll start soon. The sheet where we left off last week is being uploaded in the chat box. So those who have those who have joined from the laptop or PC can download it. Sorry, not last week, last to last week. Last week the classes were not conducted because LMS was uh, going under some technical issues. I'm good, PP. I'm good. Thanks for asking. Good evening, guys. A very warm good evening to everyone. So let's wait for a couple of more minutes and then we will start. So hello, IP. Welcome to the class. You're saying that this is your first live class. So what I would request you is go through the recordings of the earlier session as well. And in case you feel any doubt, you can raise a ticket about it. There might be cases or situations where you feel that uh, this is something that is going top of your head. So make sure that you have gone through the earlier recordings as for that you can raise a suggestion through the ticket ns, although that is not something which is in my hands. So you are able to see the excel screen, right? Guys, you guys are able to see the excel screen, right? Maybe give me reference regarding the same about the assignments and assessments. Okay, so now the screen is visible about you. PG, Prachi, if you need any of those assistance, raise a ticket about it and I'll let you know more in detail about it. Okay. Thank you, AR. Thanks a lot. So I have shared the sheet again in the chat box. Go through that sheet, open that sheet, and then allow me to start now. Now, we have made three cases. Just a second. Now, is the Excel screen visible? Okay. Now, we have made three cases, scenario 1, scenario 2, scenario 3. Now to make these three cases, I will add few lines in between. I will go with case 1, case 2, and case 3. Okay. Can I make three cases for the historical years? Can I change what has happened previously? Can I do that? Can I change what has happened previously? So for historical years, I cannot change what has happened, right? So for historical years, the case won't be valid. So I will select this whole range and do merge and center. Select this whole range and do merge and center. I don't think so, IP. If you have logged in once, it should be reflected on your LMS. Okay. Now, now, how many of you are aware about the concept of standard deviation? How many of you are aware about the concept of standard deviation? What is your idea of standard deviation? Guys, do mention this in the chat box. If not, allow me to explain. Square root of variance is standard deviation. So what is variance? What is variation? Now, in rough terms, although that is something to do with statistics, in layman terms, I'll try to explain what is standard deviation. This is price and this is, yeah, true GA. That is the definition. And this is time. Now, these are some dates in between. Now, the price of a given stock, let's say Maruti Suzuki, let's say Maruti Suzuki, if I plot that price in a graph, it would appear something like this. These are random observations. Okay. So this point over here represents the price of Maruti Suzuki at this point of time. Okay. Similarly, this point depicts or represents the price of Maruti Suzuki at this point of time. So this is how you need to learn it. Now, these are random variations, right? The deviations, these are the deviations from here to here, from here to here, from here to here, from here to here. This is how the price of Maruti Suzuki has fluctuated over time. This is how the price of Maruti Suzuki has fluctuated over time. So if I want to express it through a line, if I want to express it through a line, I will draw this line, and this line would be the trend line. This line would be the trend line. So this line is the middle of the variation that has happened. Variation that has happened over time. So standard deviation basically captures the variation of an observation, variation of an observation with respect to time. So volatile, how volatile a particular input is. Now, what I mean by this input can be anything. This could be stock prices. This input can be revenue. This input can be profits of a given company. So let's say that the average profit generated by Maruti Suzuki, average profit generated by Maruti Suzuki is 50 million. This is just a random example. So the average profit generated by Maruti Suzuki is 50 million. Now, if the standard deviation is, actually it is represented in percentage terms, let's say 20%. It means that what is the range, that I can expect of the profits of Maruti Suzuki to deviate is 50 million plus or minus 20%. 50 million plus or minus 20%. Would that mean that now, based on this 50 million, what is 50 million plus 20%? Give me these two values. What is 50 million plus 20%? It would be 60 million. And what is 50 million minus 20%? What is 50 million minus 20%? It is 40 million. So the acceptable range or expected range in which profit of Maruti Suzuki can fluctuate in a coming year is between 40 million to 60 million. The acceptable range or expected range in which the profits of Maruti Suzuki can fluctuate is between 40 million to 60 million. Does that mean I am definitely sure that profit of Maruti Suzuki won't go below 40 million? Or does that mean that profit of Maruti won't go beyond 60 million? No. This is what I am expecting out of the historical performance of Maruti Suzuki. And based on that, I will try to project how Maruti Suzuki is going to perform in few years. So based on how up or how down Maruti Suzuki has performed in its historical years, I am trying to forecast that how it is going to perform in my future years, and what tool I am going to use this to do this. This tool is standard deviation. Please understand the word standard means through a period. In general terms, in general over the, not in a specific year, but in general, how up or down a given input or a given variable has deviated from its mean. Okay, that is standard deviation. Now, there are three cases. In a bull case scenario, we are expecting profits. Just give me a second, guys. So in a bull case scenario, we are expecting profits. We are expecting profits or revenue to be better than historical averages. First of all, let us try to find out the standard deviation. Let us try to find out the standard deviation of the given inputs that has been available to us. So this has been the historical year. Let's try to find out the standard deviation of this. So is equals to standard deviation. Now there is standard deviation of population and standard deviation of sample. We will always go with sample. Why? Because population is a larger set. What I mean by that? If I had all the data, all the historical data of Maruti Suzuki, I would have gone for population. But I am taking data of last 10 years only. So out of all the data from last, let's say 50 years, out of the data of last 50 years, that is my population, I have selected a sample of last 10 years, and that I am going to include in my forecasting approach. That is why I am going to use standard deviation sample or sample standard deviation. So that is why we will be using over here sample SD, that is standard deviation. Now they are asking me for numbers. So for 2015, we didn't have revenue growth rate, so we are not going to select it. For 2016, I'm going to select the revenue growth rate. 17 revenue growth rate is 18%. 18 revenue growth rate is 17%. 19 revenue growth rate is 8%. 20 revenue growth rate is 8%, and 21 revenue growth rate is -7%. I am not very keen on including these 3 years. Why? Why I'm saying that I'm not very keen on including these 3 years. Although if you feel that to the major portion of 2019, the pandemic has not impacted the year, you could include this. But I am not very interested or very keen as an analyst. This has to do with your own judgment. We didn't selected data for 2015 because this is 0%. This is not the actual data of revenue growth rate. There might have been some revenue in 2014. Based on that, we will get some revenue growth rate. But since we didn't have that data of 2014, so revenue growth rate that is 0% is inaccurate. And that is why I have not selected data for 2015. Now, 2020 and 21 being the pandemic years, I am not very interested or very keen or I don't feel it is logical to include these 2 years as a part of our forecasting approach. So I am going to ignore this. If I feel that such a pandemic is going to happen in the next few years, in the next 5 to 10 years, you could feel including these period as well. If according to your analysis, so from here, your judgment will matter as well. From here, you can have your own approaches as well. I will try to give you different perspective of forecasting the line items. Okay, so I have not included these 2 years. Now this is 2026, 2022, sorry, 33 and 21. Based on this, I am getting standard deviation as why not 2019 data is excluded? Because COVID-19 pandemic started in November, I guess, if I remember, October or November or December month of 2019. So I feel so that it has not impacted all the months of 2019, although the last month could have been impacted. So that's why I said, if you feel that there was an impact of COVID-19 pandemic has no major impact in 2019, you could include it in standard deviation if you feel that the 8% is also an outlier. What I mean by outlier, these are exceptional items. These years are not expected to be repeated again. So you could ignore these impact. Now, based on this, what we are going to do is forecast the future years. Now, if I am in a base case scenario, I am in a base case scenario, what I will do, I will I will project the forecasted years as average of the future year's performance. So the coming year, the forecasted year, the performance that is going to happen in next few years. Yeah, that could also be a thing, CS. You are correct about it. So in case, how can you adjust it? How can you adjust it if that has happened? I'll come to that as well. Yes, I'm explaining again. I am trying to calculate standard deviation of the past few years. I'm trying to calculate the standard deviation of past few years. Now, to calculate this standard deviation, to calculate this standard deviation, I have included the data for 2016, 17, 18, then 22, 23, and 24. Why I have excluded the data for 19, 20, and 21? The reason being, the reason being that these have been exceptional years for me. These have been the pandemic years, and I don't feel that pandemic period will be repeated again in near future. So I am not going to include these years in my analysis part. Okay, moving on, moving on. Now I have to calculate the average. CS, I'll address your doubt that this could be or be based on the lower base effect. This could be based on the lower base effect. I agree with you. For that, what we could do, we could take the growth with the last positive growth rate. So that you can do to adjust it, but that would be very heavy for not everyone would have a background like you, right? So that would be very heavy for everyone to comprehend as of now, because this is your first model. But how you could adjust it is take this growth rate as the growth rate based on the last positive year, or including excluding the impact of the COVID-19 pandemic. You could do this as well if you feel that is the, and that is for the analysis part. If you feel that this 26% is based on the lower base rate, this 26% is due to the lower base rate of 2021, 20 and 20. Okay, so this has been the standard deviation. For now, let's try to keep things simple. Now average, always remember the years for which you have taken standard deviation. For those years only we are going to take average. The sheet is been uploaded on LMS. The sheet was also uploaded on the chat box as well. So AM, did you join late today? Just give me a second. Someone wants me to share the sheet again in the chat box. I will have to close the sheet because by opening the sheet, we won't be able to share it again. So yeah, I have uploaded the sheet on the chat box. Okay, fair enough. Now, the average is coming to be around 21%. The average is coming to be around 21%. Okay. Yes, I will upload in the notes section as well. The sheet has been uploaded on LMS as well. Okay. Now average is coming to be around 21%. Now, if I feel that Maruti Suzuki in its coming years is expected to perform better than its historical averages, if I feel that Maruti Suzuki in its coming years are expected to perform better than the historical averages, then what I will do, average plus standard deviation, and I will freeze standard deviation. Average plus standard deviation. And how I will freeze it? Function F4. Function F4, there would be $2 appear in front, and I will freeze standard deviation. So the same format would be copied over here as well. Just give me a second. Okay. Next, what I did over here, we calculated standard deviation, we calculated average. If I expect that revenue performance of Maruti Suzuki is going to be better, more better than the historical averages, then what you can do is, then you can add standard deviation to the historical average, and that would be the revenue growth rate for the coming year. This would be the revenue growth rate for the coming year. If you feel that revenue is going to perform worse than historical averages, then you will do average minus the base case scenario, and that would be 7.02%. Okay. Based on this, you have your growth rates ready. Now, if 141858.20, okay. Now, if 141858.20 was last year, and if the revenue has grown with 21%, what would be the new revenue? How we are going to find it? But before that, we will have to make a list, so that where we can select the case, we will be making a drop down list so that we can select the scenario, and based on that scenario, these values will be updated in our income statement. So how we are going to do this? So scenario is what we are going to select. Data, go to data, validation, select list. When it comes to source, select these three cells, click on OK. Okay. Just give me a second. The list must be delimited list or reference to a single row or column. Data validation, any value, list, source will be these three cells. The list source must be delimited list. Just a single row or column. Just a second. Okay. Okay. Let's see whether this works or not. Okay. So what we are going to do is, we are going to make Excel, although we will edit this part. We are going to edit this part later on. So what we are going to do is, we are going to punch our scenario. What we feel is the scenario. If we feel that 2 is the scenario, that is, we want to evaluate a base case scenario. In that case, We will be punching 2 if we feel that we are evaluating a bull case scenario. In that case, we will be punching 1. If we feel that we are evaluating a bear case scenario, we will be punching 3. So we will be punching the scenarios and all the values will automatically get changed in the income statement. So how we are going to do it? We are opening choose function. It is asking me for index number. Select this as index number where you will be punching the name. Freeze this. How will you freeze this? Again, function F4. Value 1. This will be your value 1, value 2, and value 3. This is something that you are going to put it over here because these, what are these? These are revenue growth rates. What are these values? These are revenue growth rates. And I'm going to apply the same format for the future years as well. So yeah, this is working for now. Now, if I want that to evaluate a base case scenario, the scenario would be second. Second scenario is the base case scenario. And as you can see, case 2 is 21%, 21% is automatically adapted over here. Now the next thing is, how am I going to forecast? How am I going to forecast the revenue for future years? To do that, I think I had discussed this in the last class as well. Go to data sheet. Go to sheet 1. Okay, I am going to sheet 1. Yes, I will be repeating choose. Give me a second. Let's suppose 100 rupees or 100 million is the revenue for year 2024. And you want to predict revenue for 2025. You know that growth rate has been 14%. What is the revenue for 2025? Please try to formulate the growth rate for 2025. Very true. What I mean over here is, if 100 million is the revenue for this year, and that revenue has grown from 14%, the new revenue would be 114. Very true. I agree with you. But how can I formulate this? Can I write the same thing as 100 into 1 plus growth rate? That would be 114. Try to apply this. 100 into 1 plus 14% will give me 114. So the formula for new year revenue or next year revenue, the formula for next year revenue would be nothing but last year into 1 plus growth rate. Next year revenue would be equals to last year revenue into 1 plus growth rate. Are you guys clear with this? This is the formula for next year revenue. So based on this, my formula for the next year revenue of 2015 will be the revenue for 2024. Revenue for 2025 would be revenue for 2024 into 1 plus this growth rate, bracket close, enter. I will simply drag this formula forward. I will drag these 3 cases forward as well. And I will drag this Control R. Now again, there are 2 approaches to it. First approach, what average shall you take? What average? Yes, I am repeating. You wanted, guys, some of you wanted me to repeat for choose function. I'm repeating for the choose function is equals to choose. Now choose what? And choose based on what? What would be the index number based on which I want to choose? So choose this. Choose the case. Now what if the case is 2? First of all, they are asking me for value 1. means what is if the case is 1? What if the number 1 is coming up, showing up? So if number 1 is showing up, select this. What if if number 2 is showing up? If number 2 is showing up, select this. What if number 3 is showing up? If number 3 is showing up, select this. Close the bracket, enter. Now, always make sure that you freeze the index number. How will you go? How are you going to freeze this index number? Function F4 when you are doing it through the laptop, and only F4 when you are doing it through a keyboard or the PC. Drag this formula, Control R. How are you going to forecast the future growth rate? As I said, the formula is equals to last year into 1 plus growth rate. Last year into 1 plus growth rate. Now, next thing. What is the next thing that we have to look forward? For instance, let's say if I expect that the market is in a very bull run, the economy is in boom, everyone is buying cars. Maruti Suzuki has made transformational changes, launched new sectors of EV. Then what could be the expected revenue that Maruti Suzuki can generate in the coming financial year? And that could be 1821055, 1821055.877, 1821055.877. Okay, for data validation, you will have to select this cell. Go to data. Go to data validation. Select list. Select source. Click on that index number and click on OK. Future forecast for the first year would be last year into 1 plus growth rate. Last year into 1 plus growth rate. Now, there are few things that we need to take care of. Again, there is perspective. I am giving you perspective. You are independent to make your own choice based on this. Now, this average that we are taking, either can be simple average or it can either be moving average. Now, the main challenge with the moving average part is case 1, 2, 3 formula for future forecast. So you want formula for these cells, right? NB. Okay. So first of all, here we have taken average of the past years. Average of past years. So average of 16, 17, 18, ignoring 19, 20, 21 because of COVID-19 pandemic, and 20 to 2024. So these 6 years we have taken average for. Now, when we have taken average for these 6 years, either what we can do is take simple average like this. When I go to the next cell, it is moving with the next cell, right? As you can see over here, these averages are moving with as I move to the next cell. Now, the challenge with these approaches, this is something, this 21% growth is what I have assumed, is what I have forecasted and assumed. Based on assumption, if I am making no assumption, is that a better approach? Or based on assumption, if I am making, based on the practical or historical data, based on the right data or reported data, I am making the new assumption, that is a better approach. What I am asking is whether making assumption based on assumptions is a better approach, or whether making assumptions based on historical data is a better approach. Yes, that is one thing. That is one thing that we are including the COVID-19 impact in it. But that is one perspective. But if COVID-19 impact would have not been there, still, when we are taking moving average, we are making assumptions based on assumptions. These three values are already assumed. And based on that, we are assuming the future values. So that is something I feel wrong. Although if you are seeing for a company, if you are feeling that there is a company which is showing a consistently downtrend from 20%, 25%, 30%, 35%, 40% growth, it has severely came down to 15%, 10%, 8%, 7%, 6%. It means that in the coming years, company's growth is deteriorating and you need to analyze and you need to keep that trend in your model. For that, you can take the moving average part. But for now, since we won't, all of us won't feel it appropriate to make assumptions based on assumptions. So we are keeping the historical cases, the forecasted growth rate same. We are keeping the forecasted growth rate same. Now this is the average. This is the average for bull case scenario. We are going to do average plus standard deviation. That will give me 28%. In a bear case scenario, we are going to do average minus standard deviation, that is 7.02%. Drag this formula, Control R, and based on that, we can forecast our growth rate. Just give me a second. Let me just copy the format. So yeah, with this, we are done with the revenue part. Now, COGS as a percentage of sales is being given to us. COGS as a percentage of sales is being given to us. The gross profit margins are also given to us. Now, if I see COGS as a percentage of sales, it has always been range bound. Why 21% is constant? Okay, sorry. Because we have not freezed this over here, function F4. Here we will have to note it down. Here also we will have to freeze it 7.02. And based on that, yeah, we have adapted our model. Okay. Next. Now, when I see COGS as a percentage of sales, the lowest value is 69%. The highest value is 75%. So similar to what we have did over here, let's try to calculate. Just give me a second. Let me just add few lines in between. Now, when I did this, when I copied this formula, Control C, Control plus, selecting the whole range and doing Control plus, the values are automatically adapted over here. Now there is also, I'm trying to give you a different approach now. Now what some analysts feel that a bull case, a market can be in a bull case or a company can be in a bull case due to two major reasons. Either the revenue is shooting up or what could happen is costs are falling down. So if the market is expected to be in bull case, again, this is an approach, right, guys? This is just an approach. So please try to be with me what I'm trying to explain. Please try to understand what perspective I'm trying to give you. So if a stock is expected to perform, the stock prices are expected to perform better than its historical average, there should be the good news associated to the company. Do you guys agree? If there is a good news associated to the company, then the stock prices will go up. Do you guys agree with me? Everyone? Now, what could be the good news for a company like Maruti Suzuki? The cost as a percentage of sales being 69% or cost as a percentage of sales being say 76%. What could be the good news for the company? what could be a good news for a company if company is expected to be in a bull case or in a bull case scenario? Do we feel that COGS as a percentage of sales would be 69%? That is a good news for the company. And if company is expected to perform worse than historical averages, then we feel it is going to perform worse than the COGS as a percentage of sales would be higher. This is one approach. Do you guys agree with this approach? Another approach is, I feel this is something that is adapted by some analysts. I feel this is not practical. If you are saying that revenue of your company is growing up, if you are saying revenue of your company is growing up, probably this revenue, for that we will have to check for revenue built. That is something different. But if you feel that revenue of your company is growing up, you are performing better. You are performing better as compared to what you have performed in past. Probably you have raised the prices of your cars. Because of that as well, revenue might grow up. Probably the inflation impact could also happen. So this I feel is something impractical. What I feel is, if your revenues are increasing, your costs will increase as well. Not as proportionately as revenue, but if your revenues are increasing, if earlier you were selling 100 cars, now you will be selling 120 cars. For that, you will have to adopt new cost of good. You will have to procure new raw materials. The cost of procuring that raw material could be higher. So based on that approach, what you can do is you can simply copy this and apply this over here. And based on that, you can say that in case one, although the revenue is increasing, the cost is increasing according to the revenue. So 79% would be, so this is freeze, right? This we will have to change. Freeze this. This is fine. This is again, we will have to change. So yeah. So as my revenues are increasing, my cost will increase as well. So if my revenue is 20%, cost as a percentage of sales would be 72%. If my revenue is in a bull case scenario, the cost that I will incur is 75% of sale. By this, I mean not only my company is performing well, but the other companies of the industry, my suppliers are performing well as well, based on the revenue front. So as my revenue is increasing, as I am increasing the prices of my car, the cost of procuring the raw materials are also increasing. This is one approach. So these are the two perspectives the analyst can think in various point of view. As a part of the curriculum, I have to give you various perspective on the lines on which you can think of, so that when you will be working on various other companies, not only Maruti Suzuki, you can implement those perspective on your research part as well. Okay. Have you got both of the perspective, guys? Fair enough. So here again, we will be going to open choose function. Let's check what is this choose function. Yeah. So what I can do is I can copy this choose function, copy this formula over here and use it over here as well. Alt ESF, Alt ESF and Alt EST. I am coming again, RS. Give me a minute. What I am saying is, what I am saying is there are two approaches. In one approach, we say that if the company is performing better than the historical averages, if company share price is rising, probably the cost of the company are falling. So if in a big bull case scenario, we should take 69% over here. But according to the economics point of view, this is something which I feel is impractical. Why I feel this impractical? It means that my revenue is increasing. My revenue is increasing and my suppliers are giving me a discount. Also, what I am saying over here is, if if my revenues are increasing and my costs are falling, this is too optimistic to be true. My revenues are also increasing and my costs are also falling. This is too optimistic to be true. So what I feel over here is my revenue is increasing, but my costs are also increasing over here. This is my perspective. This is what we have adapted in our model. Some of the analysts feel that the the rising prices could be due to two things. It could be due to increasing revenue or falling costs. So if you are expecting that the increase in price that could happen in future is due to falling cost, so I'll give you an example. Let's say that in India, they are setting up a factory for manufacturing of electronic vehicles. Earlier, the raw material of electronic vehicles was to be procured from China or USA or Singapore. There was import duty on that, and based on that, the cost was higher. But now, let's say you got a news about Maruti Suzuki that they are setting a factory for electric vehicles, and based on that, they will be seeing a sharp decline on the cost of procuring the raw materials. So the increase in share price will be due to falling COGS as a percentage of sales. In that case, the case one should be 69%. That is, COGS as a percentage of sales in a bull case scenario will be lower than the historical averages. But over here, I feel that if my revenue is increasing, my COGS will also increase. Okay. So I have kept it as the logic as I have followed in the case of my revenue. Now, these are two things: revenue multiplied by COGS as a percentage of sales. Based on this, track the formula. Oh, I'm sorry. Okay. Now, finally, I'm coming. Aris, are you comfortable with the explanation of this part? Which case shall we select? Both the perspectives. Now I want my gross profit. So it would be revenue minus COGS. That would give me my gross profit. Control R, Control C. Okay, that is something we will see what we can do about it. For gross profit, I'll keep format something like this. Sorry. I'm trying to copy the format. Let's check. Fair enough. Okay. So this is my gross profit. I will add borders to this as well. Okay. It is showing hashtag ref in growth rate. Okay. In which part? Which growth rate? Revenue growth rate or percentage of sales growth rate? M15 cell. Probably your M15 and mine M15 would have been different. Okay. Choose. So you might have not entered any number over here. That is why it might have been showing ref error. So if I am doing zero over here, it will show an error, right? So that might be the reason, or you might have not put the data validation function over here. This could be the two reasons. If it is not in one of these two reasons, you can raise a ticket and I'll try to connect what is the reason. I'll try to know what is the reason behind. Now, after gross profit, we are over here trying to got some operating expenses, and these operating expenses have been very much minimal as a percentage of sales, like 3%, 8%, 3%, 2%. So, and the fluctuations in these is also very less. So again, I feel that there is no point of in these cases, I feel that there is no point of creating these three cases. Three cases is bull case, base case, and bear case scenario for each and every line item. Why? Because in these in these four line items, this is not something that is very much contributing, not a significant contributor to the future growth prospects of the company. The proportion of this cost as a percentage of sales is very minimal. So if you are looking to the individual value, 6,301 crore is a large value. That is true. But that if we take this, if we consider this as a percentage of sales, it becomes a very minimal value and there won't be any point. So I'll give you an example what is happening over here. Let's say if I am trying to find the standard deviation. If I am trying to find the standard deviation of these values. Let me just add one line over here. Don't do this. Let me complete this and I'll let you know what I'm trying to explain. So the standard deviation is just 0.50%. So there is no much difference. There is not very significant difference in the three cases. There is not very significant difference in case of the in three cases. So due to which I will avoid making these three cases for the historical years. And what I will do is I will simply take the average. I will simply take the average formula. So is equals to average 16, 17, 18, 19, 20, 21 is what we have ignored. 22, 23, 24. This is what I feel is going to be the same trend for future years as well. Employee cost as a percentage of sales. Track the formula. Same thing I am going to do. And apply over here as well. You can use F4 for this as well. Let's suppose I want to copy the format. So for first part, I will do Alt ST. Then yes, those periods are ignored because of COVID. F4. What F4 does is it repeats the last command that you have entered in the Excel. So the last command that I did was copied the format. So I can use F4 function as a shortcut key to copy the format over here as well. Now I am going to apply the same formula, this into sales, this into sales, this into sales. Again, I'm just copying the format. Now, guys, this is something which you might feel is very reluctant or very redundant. But please try to understand having two decimals in every line item following a same code, same format is very essential for making a professional model. So when you will be getting projects, when you will be submitting the projects, these are few small things that the interviewer will look on to judge you based on what you have made. So this model, most of the crowd who can make a similar model, but these small things, if you have taken care of these minute details, your selection chances shoots up. Now formula for EBIT and EBITDA margins. This would be the same formula that I have applied over here. Although this is something coming from historical. Okay. So EBITDA and EBITDA margins, gross profit minus employee cost, selling and admin, other expenses, other income. The format that I want to include is this one. Then depreciation again, for depreciation, I will use the same formula because depreciation not being a major portion as a percentage of sales, depreciation not being the major expense as a percentage of sales, the deviation is not very much high. So this is the formula that I could use. Now, I want to freeze this. I want to, when I am going down, the first set of line item is going to is disappearing in front of me. So I want to freeze this. So Alt W F F. Okay, fair enough. Now, for now, what I should have done this. Yeah, I also want sales value, right? So for now, I should have done this, including the sales column as well. Alt WFF or WFF. Yes, is equals to this multiplied by this depreciation is equals to EBITDA multiplied by depreciation will give me my EBIT. EBIT margins. This is the formula for EBIT margins. Copying the just give me a second, guys. Let me see something. Hmm. The EBIT margins have sharply fallen down. Okay. 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 Yes, JS. So don't worry, don't worry. I have not explained that yet. So there is something wrong that we have made. There is a mistake that we have made, and we will adjust that in COGS only, probably by what we have discussed. And how I got to know that we have made a mistake is also something that I will let you know. Interest expense, percentage of sales, take this average, multiplied by sales. Copy this format, Alt S T. Earnings before taxes, EBIT minus interest. Tax expense, profit after tax, tax expense, effective tax rate is equals to average of what taxes we have paid in past. Tax expenses EBT into this equals to this minus this. Net profit margin, this divided by sales. Dividend payout ratio, dividend payout ratio is equals to average of, and 30% is coming profit after tax. Good. Now let's take care of the formatting part. The second underline is what I'm something which is I'm not very comfortable with. So I will change this second underline, and I am going to give you an important homework for today as well, which you are going to love doing if you are enjoying the financial modeling part. First of all, please highlight me that how have we made a blunder, and how that blunder will be rectified. That is something that you will have to do after the session. Probably take your time. Tomorrow is Sunday. Tomorrow morning, try to figure out how we are going to resolve that blunder. And in the next class, I am going to let you know that how actually we are going to do it. Okay, now, first of all, I will let you know what is the blunder. Here, profit after tax is 11,388. 11,000 after completion of AV, after completion of the curriculum, that is 6 months from the date that you have started, 5.5 to 6 months from the date that you have started your sessions. So I'm coming back. Case 3 was a bear case scenario. And in a bear case scenario, we are getting 11,388.60, while in a base case scenario, we are getting 8,062. And in a bull case scenario, we are getting 4,269. So from going to bear to bull, our net profit is falling or dropping down. But what should have been there? The right thing to happen would have been when I am going from bear case scenario to a bull case scenario, my actual net profit should have been increasing instead of falling. My actual net profit should have been increasing instead of falling. So what could be the reason of this happening? How can we rectify it is something that you guys need to think of. Okay. Now with this, our income statement is ready for now. For now, our income statement is ready. Now the only thing I am going to make financial statement of balance sheet and cash flow over here. So the only thing I want to do is link the forecasted future years in my actual financial statement. Now, this financial statement won't be historical anymore. This would be financial statement with, with historical data as well as forecasted data. Once you are done with this assumption part, do you guys need break for 5 minutes so that we can resume after a short break? Fair enough. Go on a short break, but be right back on time. Meanwhile, I am making the formatting adjustments and applying some formula which were left off. So in a project, you will have to make a DCF model, full-fledged DCF model yourself. That would be your project. Next, you will receive a mail about it. So don't worry about it from now itself. You will have to submit it through a portal. You will receive guidance about how can you submit that project. But now the assignment is, the homework is that this is the error. In a bull case scenario, the net profit margin is 2%, whereas in a bear case scenario, the net profit margin is 7%, which is exactly opposite. What may be the reason of that happening? You need to figure out this. Got it. February 25th. So around 50% of the curriculum is over for you. In fact, not 50, but 80% of the curriculum is over for you, AR. For mock interviews, yes, I'll be there for you. For resume building, there is a different team who will be taking care. There is a pre-placement team who will be taking care of this. I'll give you a hint, guys. First hint is try to figure out this with the help of Cox with the earlier approach that we used. Then the second hint is, can you see over here for selling and admin? For selling and admin, the expenses have drastically fallen in year 2024. And for other expenses, the expenses have drastically shoot up. It means that this is a error. This is a error. It means that all the expenses that happens generally in selling and admin, screener has considered that in other expenses for this year. Screener has considered that as other expenses for this year. Is my voice breaking, guys? Am I not clearly audible? So Niranj, probably there might be an issue from your end because I'm getting few responses that the voice is clearly audible. Okay. So try to think in these terms. What has happened is screener has considered selling and admin in other expenses for year 2024, and because of that impact, there are some adjustments. There are some adjustments that we need to make. Try to make those adjustments, and we are going to make those adjustments together in class tomorrow. Although there might be other approaches of rectifying this as well, I would be very happy if you come with your own approach tomorrow and we will have a discussion on it. Starting with financial statement, let's try to link the assumption sheet with our financial statement. So let me add a line above this, that is historical. Control C. Alt TST, Alt TS. Similarly, I will link this as well. Alt TS L, Alt TS T, Alt HO I. Next is revenue. Do one thing. Copy this. Control C. Alt S L. Okay. Drag this formula. Next, go to assumption. Link COGS. Drag this formula. Drag the formula for gross profit. We will take care of the formatting part later. Employee cost, link it. Drag the formula. Drag this formula as well. Assumption. Gross profit. Drag the formula. Yes, all the formulas have already been mentioned in the comment part. As you can see over here. The growth rates formula, if you want, I can mention that. Next year, revenue is equals to last year revenue into 1 plus 1 plus growth rate. For growth rate, last here we have taken average, that is fine. So here we have simply linked it from here. So we have used the choose function. For rest of the things, gross profit, all these formula have already been mentioned in the financial statement part. So you won't face any challenge while navigating through the formula in case you have practiced this earlier. Selling and admin. Other expenses. Other income. Depreciation. Don't worry. Once we are done with this part, that is something which is a boring part, which we are just linking these things. Then we are going to go for the most exciting part, that is matching the balance sheet, where most of the students face challenge. Interest expense. Growth rate. Over here, you can see revenue growth rate formula is already been mentioned. This year, last year, -1. In assumption, the growth rate has been derived from the historical growth rate or average growth rate using the choose function. Growth rate formula is already been given to you guys. Also, sincere request during the weekdays as well, please do practice through the model, because once you stop practicing, you are going to face challenge, and that is for sure. Tax expense. Dividend. Dividend payout ratio. Next, sometimes we feel, and you will see that we are facing challenge in when we are navigating from bottom to top, that what are the historicals here and what are the forecasted years. For that, let's highlight the forecasted part in a different color. Okay. And the format part, I'm going to take care of it in the next 1 minute. Okay. You can work on this through your own set of color combinations. That is perfectly fine. And with this, we are done with the income statement part. Now let's go on to the balance sheet. We will construct balance sheet and cash flow statement together. Going to copy this, put it over here. Okay. Copy this timeline. Control C. Perfect. Now just copy the same format. You might feel that we are going a bit fast, but this is the need of the hour, guys, because this is something that we have already discussed. And you will find it extremely useful when you will follow these steps on your own while going through the recordings. It will speed the process up for you as well. Okay. Okay. Now, shall we start with the balance sheet and cash flow statement? Guys, are you ready? Are you ready, guys? Shall we start? Because we have not made anything yet. Why all zero? Because we have not entered anything yet. That is why the values are coming to be zero. For equity share capital are generally considered to be consistent. All the all the adjustments are made generally in reserves part. So we will keep equity share capital consistent like it had been consistent for the historical years. So this will be my equity share capital. Formula for reserves is last year plus net income minus dividend. Last year plus net income minus dividend. Borrowings. Borrowings I will have to forecast. So what are the elements that I am going to forecast for my balance sheet is borrowings. Let me just highlight this. We will be forecasting borrowings. We can forecast other liabilities as well as percentage of total liabilities. We are going to calculate net block. Capital work in progress. We can keep it consistent. Investments and other assets. We can also go for other assets as well. Receivables, inventory. Okay. Fine. Other liabilities. Okay. Fair enough. Okay. Now the question is how we are going to forecast all these things of the balance sheet. First of all, let's start with net block. For net block, we are going to make, I am again in the assumption sheet. For net block, we are going to make a PPE schedule, property, plant and equipment schedule, where the beginning period PPE less depreciation adding purchase of PPE will give me my ending period PPE. Now for ending period PPE, I already have data of my net block. Okay. My beginning period PPE so how is the financial modeling different than what the company CA would be evaluating? The main difference between accounting and finance is something forward looking. We are going to forecast and predict what is going to happen in future years. And what CA will be doing is CA can also make use of financial models. CA learn financial model. Financial modeling is a skill. CA is a certification. So using financial modeling as a tool, you are going to implement what a CA is going to implement what he has learned during his course time, during his curriculum days. Beginning period PPE is equals to last year ending period PPE. So we are going to link this. Less depreciation So depreciation expense for 2016. Make sure you take this for 2016 only. Now, what is PPE? PPE is per property, plant and equipment. Now this ending period is beginning less depreciation plus purchases is equals to ending period, right? If I have the other three factors, can I calculate the fourth one? Can I write this ending period PPE as ending minus beginning plus depreciation? So these are my purchases of PPE. This is nothing but when you see over here, fixed assets purchased. These are nothing but my fixed assets purchased. So we are going to make use of this when we will be going for the cash flow statement. With this, I have my ending period. Okay. This is my ending period PPE. Now, purchase of PPE. Let's try to calculate this as percentage of total, or let's try. We have data for only fixed assets? Yes. So let's try to calculate this as a percentage of fixed assets. Percentage of fixed assets. So this divided by net block will give me the percentage of fixed assets that has been spent, that has been purchased every year. Oh my God. So this is very fluctuating. Okay. What else can we do? What we can do is we can try to figure out fixed assets as percentage of, okay, PPE as a percentage of sales. So higher the sale I will make, higher the machinery I will need. PPE sales. This is somewhat consistent. Okay, so this would work. Okay, now again my ending period would be, sorry, my beginning period would be last year ending period. I will drag the formula, less depreciation. I have forecasted depreciation, expense, purchase of PPE. Again, it will be coming from the same formula, PPE as a percentage of sales, average of the past years. There is nothing, it doesn't seem to appear like they have sold any PPE during the COVID periods. So we can take average of the past years without ignoring the outlier of COVID time. If you want to incorporate the trend, you can do that as well. That is also perfectly fine. Ending period PPE is this multiplied by sales 33,265, control R, purchases, track the formula. So this is, with this we have our PPE schedule ready in front of us. So how, any doubts? Anyone has any doubt that why, how we have calculated this purchase of PPE? Basically, it's very simple. We had this beginning period we had this ending period PPE. The ending period PPE for the last year would make the beginning period PPE for this year, property, plant and equipment. We are subtracting depreciation from it, and the balancing figure is our purchase of property, plant and equipment. This is what we have done in the future years as well. It's just that for future years, the ending period PPE is calculated as a percentage of sales. Okay. Also, some of the line items I have missed, making it to two decimals, make it to two decimals on your own this time. Okay. Now I have my ending period PPE available with me. I have my ending period PPE available with me. I will copy this and this will become my PPE or net block. Capital work in progress, keep it same as last year. Other assets or investments, keep it same as last year. Other assets. This is my other assets. Property, plant and equipment. PPE is property, plant and equipment. Machinery is property, factories that you have installed. These are the other assets. Other assets as a percentage of total assets. Let's check whether this is fluctuating or this is something which is consistent. Other assets as a percentage of total assets. Okay, this is fine. This is as a percentage of total assets. Do we have our total assets? Because no, we don't have our total assets because total assets would be sum of other assets in future. We don't have our total assets figure with us. So that is again to be considered as percentage of sales only. This divided by equals to average. With this, I have my other assets available with me. So I will take other assets over here. Receivables. Control C. Receivables. I am linking receivables over here. Next, receivables. I am going to forecast based on receivable turnover ratio. I had calculated receivable turnover ratio from year 2015. Do I have? No. So I will have to calculate from 2016. Receivable turnover ratio 2016. Okay. What is the formula for receivable turnover ratio, guys? What is the formula for receivable turnover ratio? Sales upon average receivables. So if I have my receivable turnover ratio with me and I have my sales with me, what will be the formula? Now in receivable turnover ratio, what generally happens is company has managed to bring down this receivable to 35.92 over the period of time. So there is no point of taking average of all the past ratios or of all the past receivable turnover ratio. So generally what is taken is the last year receivable turnover ratio for all the future years. Now I have my sales upon average receivable as my receivable turnover ratio. I have my sales as well. Let's try to work on some basic algebra and try to find the forecasted receivables for the given period. The similar concept we are going to apply for payable turnover ratio as well. So receivable turnover ratio is sales upon average receivables. Now I have my sales value with me. I have my receivable turnover ratio with me. Can I get average receivable as sales upon receivable turnover ratio? Can I do this? Can I get my receivable as sales upon receivable turnover ratio? Guys, just using some basic algebra. Can we do this? Can we implement this? Correct? So the formula would be sales divided by receivable turnover ratio, which gives me my average receivable. Try to figure this out for payable yourself. We will do this for inventory together. For inventory, inventory we have right from year 2015. Formula for inventory turnover ratio. COGS upon average inventory. COGS upon average inventory. Now inventory turnover ratio will be this. is equals to, if I want inventory, it would be COGS divided by inventory turnover ratio. With this, I have my inventory. Finally, I have my inventory turnover ratio with me. Sorry, I have my value of inventory with me for the future years. Capital work in progress, we have kept same as of last year. Cash in bank, we will be calculating at last. And when we will link cash in bank, what should happen is our balance sheet should get matched. Now, other liabilities, we have taken other liabilities as a proxy for payables. So let's forecast other liabilities to payables only. Other liabilities are considered over here as a proxy for payable. Concept behind this formula, cost of capital, ratios, financial statement, etc. However, we are majorly learning about how we can use Excel for these concepts when we will learn the concept behind this formula. So when we discussed about ratio analysis, we discussed that what is the interpretation of all these ratios. Why we are focusing more on the Excel part? Because financial modeling is the implementation of what we have already learned. So about the cost of capital, there is a different module for ratio analysis. I guess with ratio analysis, we have covered the major things. For financial statements, there is financial statement analysis, which we have learned. And if it has been not completed for your batch, it will be completed at the later point of time in this course as well. So we are going to discuss everything in detail and with most of the depth. So the concept behind this formula, if you have gone through the recordings and revised what has been covered, you are going to understand the pickup will be very strong. You are going to understand we are projecting receivables, we are calculating receivable turnover ratio, and based on that, we are forecasting what is going to happen in future years. Yes, correct, PM. In case if you feel that there is a specific concept that you are not feel feeling that is touched upon in the class and you need more detailed analysis of it, you can raise a ticket about it and we can connect one-to-one over the session to address your doubts. Other liabilities considered as a proxy for payables. Other liabilities considered as a proxy for payables. Payables, payable turnover ratio. This is my other liabilities. Payable turnover ratio, we will take care. Over here, the formula would be COGS upon average payables. COGS divided by average payables. Now, we will be dragging this formula future years. With this, we have our other liabilities in the form of payables as well. Now borrowings, borrowings. Okay, let's try to calculate. Still, I don't have my total assets with me, right? Borrowings. Although there is no need to calculate borrowings actually, because debt is a very small part of the total capital. Debt divided by sum of equity share capital. It's 2%, and let's see whether it has been consistent or not. Okay, 0.0. It has been falling, consistently falling. Okay, means that company is paying off the debt. Doesn't seem to have. Company has paid off the debt. Fixed assets purchased, proceeds from borrowings, repayment of borrowings. Company is paying off the debt. Company has paid the major portion of debt, and since they have paid off the major portion of debt, yeah, we can take last year borrowing, but the reason I want to take it for the future years to make it adjust for the make show it as an adjustment in cash flow statement as well. So let's keep it simple. Let's keep it as a percentage of sales. Let's keep it as a percentage of sales because we don't have our ready working capital with us. Do we have our working capital ready with us? Current minus no. Yes, yes. Yes, we can do other liabilities minus current assets. Okay. Yes. So what we will do, we will try to calculate working capital, and based on that, we will be calculating borrowings. We could have, I also thought about it, but we don't have our total assets available with us. So how we cannot use debt to asset ratio in that case. Although we have total fixed asset, so borrowings as a percentage of total fixed assets could be something that could be considered. But since the company is paying off major portion of the debt, I believe that based on working capital would also work, although we could have also taken it for total assets as a percentage of sales. So total fixed assets and non-current assets. Let's take it based on total fixed assets. We cannot take it as based on debt to asset ratio GA because we don't have our total asset available with us. But we can definitely take it based on total fixed assets. Borrowings percentage of total fixed assets is equals to my total fixed assets available with me. So yeah, with this, my balance sheet is ready. Now, now our ending period cash balance should be 13,120 to match the balance sheet. So if these are the values that we will get while making our cash flow statement that we will be doing tomorrow, then our balance sheet will get matched. So that was it for the day, guys. I will share this sheet with you. We will have to take care of some formatting parts as well. So we will do that. Rest everything is fine. Make sure that if possible, go through the recordings of the sessions again. I hope you enjoyed the session. So if you have any doubts, we can address that tomorrow as well. Make sure that two things that I want to, please don't leave the session. Let me conclude the session in a couple of minutes. First of all, confirm me, have you received the sheet in the chat box? Perfect. Next, two assignments for you are, two homework that you need to do is, first one, you will have to try to make or construct the cash flow statement by yourself and try to match the balance sheet. This is first. Second, we are getting an error over here. That is, we are getting a difference over here that when we are taking the best case scenario, the profit margins are turning out to be worst. So try to make adjustment of this. One suggestion is try to focus something over here, try to adjust something over here. And based on that, you will be able to solve itself. Also, if that is not happening, try to go for COGS as well. So work on it. Tomorrow in class, we will do this together and try to figure out what the actual challenge is. So that was it for the day, guys. I hope you enjoyed the session. And we will see each other tomorrow, but make sure you do practice the sheet that has been provided to you. Thank you, guys. Thanks a lot. Waiting for your feedbacks that whether we should go slow, fast, whether the pace was accurate or not, how you felt about the session. Thank you, guys. Thanks a lot. This is good. Thank you. Very difficult to learn alone. I agree with you. Just go through the recordings of the session as much as possible. In case you feel that you have any doubt, I would be happy to help you out. Okay. So that's all, guys. Thank you. Thanks a lot. Bye-bye. Take care. Have fun. Thank you, PP. Thank you, Karuna. Thanks a lot. Bye-bye. Take care. Have fun.